All right, so switching gears, let's look at gift tax strategies for non-US residents. So again, estate taxes are assessed upon death on the value of the estate. Gift taxes are assessed while your client is alive when they're making transfers during their life within the United States if they're a non-US resident. So here, again, annual gifts. So every year, non-US residents have the same exclusion as US citizens. They can give $15,000 per year per donee. So again, if you have 4 children, you can give each one $15,000 per year. That's $60,000. Okay, so it's per donee that the annual gift tax exclusion applies. And again, non-US residents, in addition to US citizens, enjoy this annual exclusion. There's also a super and again, okay, so let's switch gears and talk about gift tax strategies for non-US residents. So again, estate taxes are assessed upon the death of the taxpayer. Gift taxes are assessed while they make transfers during their life. So if it's a non-US resident, it's only transfers made within the United States. So first of all, the annual exclusion of $15,000, everyone enjoys that. US citizens, non-US citizens, non-residents, they can give $15,000 a year just like US citizens within the United States. So that is assessed per donee. So what that means is, for example, if you have 4 children, you can give them $15,000 per year. That's $60,000. So it's per donee, not per donor. All right. So in addition to the annual gift tax exclusion, non-US residents can give to their spouse, who is also a non-citizen, $157,000 per year. Like that's scaled for inflation. That's the current amount. So if you have a non-resident married couple and they want to make gifts to each other while they're alive, again, they have a super annual exclusion of $157,000. The code also carves out exemptions for gift taxes for non-US residents. And again, these are in the code. No action needs to be taken other than awareness that they exist so that your clients can take advantage of it. So gift taxes that are not subject to gift taxes for non-US residents, transfers to political organizations. If they want to make donations to, a university or, the government, whatever, that's not subject to gift taxes. Transfers to healthcare providers. If your client is, their children need a surgery in Houston, and at the children's hospital, and it's $100,000, as long as they pay the institution directly, the healthcare institution, that's not subject to gift taxes for healthcare bills. But they have to pay the institution directly. They can't give it to the child and then the child pays. Transfers to educational institutions for tuition. Again, let's say you have a client from Brazil, and their son or daughter is studying at Rice University, and they need to pay tuition. Again, that is, they can pay the tuition directly to the university. It's, again, exempt for non-residents. But again, they have to pay the institution directly. They can't give it to the child and then the child pays. Another huge exemption for gift taxes for non-US residents that are not available to US citizens is transfers of intangible property. And this one's huge because when it comes to our clients, we use this one a lot. So a non-US resident can transfer intangible property and not be subject to gift taxes. So we look at the code there, 2501, they can make gifts of shares of stock in a domestic corporation. Okay, so that one's huge. So what that means is, if your client sets up a corporation here in Texas, for example, and they transfer a portfolio fund, real estate, all kinds of US-based assets into this corporation, and they make gifts of these corporate shares to their family members, that is not subject to gift taxes for non-US residents. This is huge. This is not available to US citizens. This is only a special carve-out for non-residents. Another huge exception, there are debt obligations. So let's say your client has a bunch of municipal bonds or treasury bonds that they invested with the United States. The value of those bonds are exempt for transfer for gift tax purposes. They can gift them while they're alive to family members, and these debt obligations of these bond portfolios would not be subject to gift taxes. Okay. Additional gift tax strategies for your non-U.S. resident clients is make gifts outside the United States. Because remember, only the gifts made within the U.S. are subject to gift taxes with the IRS. So they can make gifts outside the United States to family members to purchase U.S. status assets. Again, that's another strategy to avoid gift taxes with the IRS. Number 6, we can set up a business entity, an LLC, limited partnership corporation, here in the U.S., and they make gifts to family members to purchase U.S. situs assets within this entity. Number 7, same thing as above. However, we add irrevocable trusts to own the membership interest or the shares to avoid estate taxes after the grantor passes away. All right, so let's look at some examples of this on the chart. So here's an example where we can set up an LLC. And in this example, we did a series LLC. This client has an investment portfolio. Let's say they have 4 different rental properties in the Houston area. They're non-U.S. residents, and we want to protect these 4 rental properties. So we can see here with the series LLC, we set up 4 subsidiaries. You can see them there on the right, because we want to title the different real estate assets into a different subsidiary, so they're not subject to each other's liabilities. So for example, let's say we have a rental home in Series A. The tenant sues the owner because there's some kind of an accident there in the rental home. Well, if we put the other properties in Series B, Series C, and Series D, it's not going to be subject to that lawsuit of the property in Series A. So that's why we use a series LLC in this example if the client has multiple real estate investments. So let's say the value of this real estate, let's use a real example. I actually did this for a client from Mexico City that has properties in Florida, Texas, and California, and we did this series LLC for him. In addition to segregating the assets in different subsidiaries, we created trusts to own the actual membership interests. In this case, we have a management trust, and then we created an irrevocable children's trust. And then we make gifts of membership interests to the children's trust, which is again exempt as an intangible asset for non-U.S. residents. So let's go back to the chart. We can make gifts of intangible property, which are corporate shares, exempt for non-residents for estate tax purposes. I'm sorry, gift tax purposes. So we go back to the chart. We make gifts of, oh, by the way, this LLC is taxed as a C Corp, so it's a corporation. And we make gifts of corporate shares to a children's trust while the client is alive. So again, for non-U.S. residents, this gift of corporate shares falls within the code definition. It's exempt for gift tax purposes. And guess what? Since it's an irrevocable trust for the children, when mom and dad pass away, the grantors, no estate tax is due because they made the gift while they were alive to an irrevocable children's trust. So the children would owe 99% of this corporation as non-voting members. So it's not only an estate tax and gift tax savings for the non-resident client, it's also their estate plan. Now we have to be very careful how we design the LLC and the trust. As you can see there, I have some notes there for distribution and liquidation restrictions and distribution trustees. We'll get into detail of why I did that in a second. But I just wanted to show you an example of what the entity would look like. So again, this is the strategy that I just outlined: set up an LLC, corporation, LP to purchase U.S. situs assets, and they make gifts of company shares to family members. And again, that's under the safe harbor of gifting intangible assets, gift tax free for non-residents under the code. In addition, it knocks out estate taxes for the subsequent generations, as long as those irrevocable trusts own the corporate shares. Now, a caveat: when it comes to gifting partnership interests or LLC membership interests, the IRS's position is they don't want to make a ruling if this qualifies as an intangible asset for non-residents. Because if you go back to the code specifically says Intangible property, B number 1, shares of stock issued by a domestic corporation. It doesn't say partnership. It doesn't say LLC membership interest. It says stock. So what is the IRS's position to gifting partnership interest or LLC membership interest that's not taxed as a C Corp? Well, the IRS will not rule on it. So use that strategy with caution, which is why I like to err on the conservative and make sure that this is a C Corp so it falls within the safe harbor of the code. But again, if you're gifting partnership interest or LLC membership interest, again, you're in the gray zone. The IRS is not ruling on it.